Want to read a company's financial statements like a detective, spotting traps, finding hidden value, and separating real businesses from clever stories? In this video, I'll teach you Benjamin Graham's practical, no-nonsense approach to security analysis for the lay investor and show you the per-share earnings tricks that can fool even smart people. If you can read a balance sheet and think a little critically, you already have most of what you need. Let me show you how to use it. Chapters 11 and 12 are where theory becomes workbench. Chapter 11 hands you a practical framework for doing basic security analysis, what to look at first, how to judge bonds versus stocks, and which numbers deserve real attention. Chapter 12 dives into a deceptively important topic, per-share earnings. Earnings numbers are the headline, but they're also where accounting choices, one-off gains, and management creativity can hide the truth. In this video, I'll translate Graham's rules into plain English and give you a step-by-step checklist you can use the next time you open an annual report. Imagine two investors are handed the same company report. One skims the glossy front pages, nods at the marketing language, and buys because management seems confident. The other flips to the back, looks at interest coverage, working capital, and the footnotes, and walks away. Graham's point: the second person is doing security analysis. The first is auditioning for a TV ad. The rest of Chapter 11 tells the lay investor how to be the second person, clearly, practically, and without a PhD. Graham says, start where the facts are, the financials. The management discussion can be useful for color, but the numbers are the ground truth. Open the balance sheet and ask, is the company solvent? How much debt? What's the working capital position? Then read the income statement. Are earnings stable, rising, or erratic? Finally, inspect the cash flow statements and footnotes. These are where the story often hides. Graham encourages beginners to learn bond analysis first, because it's cleaner. Measure interest coverage ratios, check whether earnings cover interest payments over several years, and spot preferences or subordinations. For bonds and high-grade preferreds, reliable coverage metrics give you a defensible view of safety. Numbers you can actually judge. If interest coverage is weak or falling, the bond may not be safe even if its rating looks okay. Common stock analysis is more art than science, but there are sensible anchors. Graham recommends looking at a period of several years, not just one-year breakouts. Use multi-year averages for earnings, examine dividend history, and consider tangible asset backing versus price. Pay attention to the firm's industry cycle. Some businesses have volatile earnings by nature, but don't let that excuse sloppy balance sheets. The goal is to estimate conservative intrinsic value and buy with a margin of safety. Here's a pragmatic order of operations Graham suggests. The lay analyst's checklist. Confirm solvency. Current assets versus current liabilities. Tangible net worth. Check interest and dividend coverage. Trailing multi-year earnings divided by interest, plus preferred dividends. Look at earning stability, multi-year averages, not one-year spikes. Examine dividend record. Consistency is a huge signal for quality. Assess leverage and debt maturity. How soon does major debt come due, and what's the refinancing risk? Study footnotes and contingencies. Lawsuits, guarantees, off-balance sheet liabilities. Consider valuation. PE versus historical norm and peers. Price versus book. Price versus conservative asset backing. Decide margin of safety. Buy only when price has a comfortable gap below your conservative value estimate. Graham constantly emphasizes averaging. One-year earnings spikes from a tax benefit or an extraordinary sale don't prove future earning power. Conversely, a single down year during a cyclical trough shouldn't make you panic if the balance sheet is strong. By looking at multiple years, you smooth out noise and reveal the underlying business strength. Think of it like judging a chef on multiple meals. One great plate, or one disaster, isn't the whole story. Graham warns that the footnotes often contain the salient facts: pension obligations, lease commitments, tax contingencies, and accounting policy changes. If you skip them, you're skipping the most candid parts of the report. Always read them. They're longer than the puffed-up management letter, but they're worth every minute. When making a rough valuation, Graham recommends conservative assumptions. low growth rates, no miracle margin expansion, and cautious multiples. If your reasonable estimate requires heroic growth assumptions, the price isn't safe. The conservative valuation becomes the anchor for deciding whether there's a margin of safety. The central Graham concept. Say a company shows an average earnings yield, inverse of PE, of 8% over 3 years, yields a 3% dividend, and has a modest debt load covered several times by earnings. If the stock sells at a price implying a 6% earnings yield today, you can see the margin. Is that 2% cushion enough given sector risk and debt? If not, walk. Graham prefers simple arithmetic and real skepticism to fancy math. Earnings per share, EPS, is the number everyone quotes. It's on the front page of financial sites and in headlines. But Graham points out that EPS can be wildly misleading if you don't understand what's behind it. One-offs, accounting shifts, share count changes, and goodwill write-offs. Chapter 12 is a primer on how to read EPS skeptically so you're not dazzled by illusions. Companies can influence EPS through legitimate accounting choices, like depreciation methods, inventory accounting, and revenue recognition. These rules aren't fraud, but they can change the timing or appearance of earnings. A crucial part of the lay analyst's work is to spot when accounting policy shifts explain an EPS change rather than real business improvement. Companies sometimes report big, special items, gains on asset sales, tax benefits, or restructuring charges. These skew EPS. Graham's practical rule: separate recurring operating earnings from one-time items. For your valuation, focus on normalized operating earnings. Then decide whether the one-off should change your view. EPS is per share. If the company issues many shares, via stock compensation, convertible issues, or acquisitions paid in stock, EPS can look fine, even as ownership is diluted. Graham recommends looking at total earnings relative to the company's market value and at per-share metrics adjusted for dilution. Always check the change in shares outstanding over time. Graham warns that management sometimes classifies recurring items as extraordinary to hide them from core EPS, a bit like putting regular maintenance expenses under special charges. If a supposedly extraordinary item repeats, treat it as ordinary. Don't let the labels fool you. Look for repeatability. Earnings are an accounting construct. Cash flow is real money. For a sturdier picture, compare EPS trends with operating cash flow and free cash flow per share. If earnings rise but cash flow doesn't, ask why. Is revenue being booked earlier? Are receivables ballooning? Graham prefers facts over paper profits. When analysts extend a great one-year EPS into forever growth assumptions, they set themselves up for failure. Graham emphasizes conservative extrapolation. Short-term spikes should not become long-term baseline assumptions unless there are clear, repeatable drivers. If your valuation depends on sustained high growth, ask for proof. Use this quick protocol when assessing per-share earnings. Adjust EPS for one-offs and extraordinary items. Normalize using a 3 to 5 year average for cyclical businesses. Check dilution. Adjust EPS for share count changes. Compare to cash flow. Operating and free cash flow per share should support EPS. Ask why. If EPS grows, is it margin expansion, volume growth, cost cutting, or accounting changes? Only the first two are durable. Graham gives examples of companies showing a miracle quarter, EPS spikes from non-recurring events, followed by significant disappointments. The lesson: spot the miracle, strip it out, and if the remaining earnings don't justify the price, don't buy. The market loves miracles. The intelligent investor respects the ordinary. Here are the practical rules from chapters 11 to 12 that you can act on right away. Start with the numbers, not the marketing. Read the balance sheet, income statement, cash flows, and footnotes before you believe a CEO's narrative. Use multi-year averages, smooth earnings and coverage ratios over several years to see the real trend. Scrutinize per-share earnings. Adjust for one-offs, dilution, and accounting choices. Compare EPS to cash flow per share. Value conservatively, and demand a margin of safety. If your valuation depends on heroic assumptions, the price isn't safe. Which of these checklist items will you add to your next earnings review? Read footnotes or normalize EPS. Tell me in the comments and paste one line from a real company report you've wondered about. I'll help you interpret it in a future video. If you want a downloadable one-page checklist of the steps in this video, type earnings checklist in the comments and I'll drop it in the description. If this helped, like and subscribe for more practical breakdowns of classic investing wisdom. Next video will apply these techniques to analyze a real annual report, line by line, so you can see Graham's method in action. Say analyze in the comments if you want that live walkthrough. Thanks for watching. See you in the next one.